Welcome to another edition of Econ Updates. I'm Steve Taddie, Chief Economist with Hoyle Cohen Wealth Management. Now, the key takeaways for the last 2 weeks could be summed up in 4 issues. One is the budget showdown, which once again turns out to be more grandstanding and partisanship than substance, but that can be marked off as solved as the politicians have kicked that can down the road for 45 more days. We'll see it again come mid-November. The United Auto Workers strikes seem to be selectively expanding, going beyond the auto manufacturers and trying to infiltrate the corporations that manufacture the parts for the automakers. Student loan payments start up again on Monday, and it's estimated that about $100 billion per year will be redirected from what has been retail spending to making loan repayments. And lastly, oil prices have moved from $70 a barrel to $90 a barrel since midsummer, again, causing some redirection of retail spending from other items to gas in the tank to get to work, et cetera, et cetera. Actions that we have seen during the last couple of weeks is we've seen central bank action here and abroad, with the Federal Reserve pausing their rate increase regime, but talking about 1 to 2 more rate increases going forward. The EU raised their rates by a quarter point and talked about a ceiling being near, and the Bank of England left their rates unchanged. On the comparison of the central banks, the EU and the Bank of England is facing a much different scenario than we are here in the US, where they have stagnating economic growth and higher inflation rates than we have here. In the US, we're facing a situation where our federal funds rate is now well enough above inflation that we've got a real Federal Reserve interest rate, and it takes a little bit more bite out of the economic growth when you have a central bank lending rate that is above the inflation rate. On the longer term bond side, the US is running at about a 4.6% 10-year rate, compared to the German government bond at 2.7%. And using that real term again, in the US, investors are getting a real interest rate over and above inflation, whereas in Germany, they're still battling with a negative real rate of return for funds invested in the German government bonds. The US dollar has been stronger against their trading partners, with specifically the dollar being about 15% higher versus the euro since midsummer. And earnings per share in the US has been coming in as expected. And actually last quarter, many companies beat their earnings expectations, but it's the valuation of those earnings which has come into question. And the valuation, or the PE ratio, has dropped by about the same percentage as the price of the S&P 500 has since the August 1st high. Looking at stocks, they've broken below their uptrend support levels and broken below some other important support levels, which means it might be a slower slog going forward to regain the summer highs. And with the interest rate being at 4.6%-ish for the 10-year Treasury, it represents about a 15-year high in the US Treasury. The good news is that one of the uncertainties that haunted us during the quarter has been solved, at least for now, with the budget showdown being over. That's where we start the week. Thanks for tuning in.